Hello, everyone, and welcome to the NinjaTrader Ecosystem webinar room. Before we get started, I would like to take a moment to test for picture and sound. So if you can hear my voice and see the projection in the room, please type a Y. Perfect. Thank you, everyone, for confirming I am coming in loud and clear. We have a very special event for you today with Tushar of Chande Indicators, LLC. I am going to place a poll in the room if I could get everybody to fill that out. And while you fill that out, I would like to mention it is important to understand that there are substantial risks in trading commodity futures, contracts, and forex. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstances and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond this amount. Please inquire at the following link for a full copy of the CFTC risk disclosure or if you have any additional questions. Also, please remember that these training webinars are not a solicitation nor a recommendation, but simply educational in nature. This presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Any brokerage-related questions should be directed to the NinjaTrader brokerage using the following phone number or email address. Thank you, everyone, for filling out the poll. I am going to share those results. The question was, what initially brought you to the NinjaTrader ecosystem website? 32% of you are searching for apps and add-ons. 59% are looking for trading education. 5% are looking for programming assistance. And 3% of you are joining us live for your first webinar. With new tools added nearly every day, NinjaTrader ecosystem is home to hundreds of apps and services. You can quickly and easily find you can quickly and easily find tools or services you are looking for with a simple keyword search. You'll also find information about upcoming webinars and an on-demand video archive to view previous events. Also, if you are active on social media, we do ask that you follow us on both Twitter and Facebook to get all things NinjaTrader live every day. NinjaTrader is always free for advanced charting, strategy backtesting, and trade simulation. To ensure you are on the latest version of NinjaTrader and to pick up a free live data trial, please visit the following link. You can also purchase or lease NinjaTrader using the following link. And if you are just getting started with NinjaTrader, we offer free live training on a daily basis. You can view a schedule of upcoming weekly webinars at the following link. We are very excited for this unique event in which Tushar will show you step-by-step how to recognize breakouts and how to improve your trading consistency using entry filters and accelerating exits. Thanks again for your attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, Tushar. Tushar, go ahead and take it away. Tushar, you're muted, so you'll need to unmute yourself to begin your presentation.
Okay. All right. Hello, are you hearing me now? Okay, good. Sorry about that. Well, let's get started again. Good afternoon, everybody. Welcome for that. Thank you for being here, and sorry for that little glitch over there. We had gone through the setup, but somehow it must have changed. The gremlins strike. I'm going to run about 30 minutes, so we'll have 10 minutes at the end, and hopefully you won't be shy with your questions. The topic is trading breakouts like a pro. So we'll talk about entries and filters and exits and how to put them all together in interesting and different ways. The disclaimer is important. Please remember that no system or indicator is perfect, and there's always risk of loss in trading.
Tushar?
Yeah?
Your screen is not sharing.
Share screen.
There we go. It's beginning. There you go. Perfect.
Sorry about that. let's see. Essentially, this presentation is for edutainment purposes. So to educate you about my indicators and entertain you with some new ideas. So hopefully this will give you a sense for how you can put different bits and pieces together to have an interesting trading system. The three main groups of ideas I'll talk about are entries in terms of adaptive breakouts, filters in terms of short-term and long-term oscillators, so you can get a little bit better entries, and then exits, so that all of us, we need exits, so we don't have to, so you'll have different flexible ways of getting out of your trade. If you remember only one thing from today, remember this. My new technical indicators adapt automatically and are simply plug and play, so they don't have a steep learning curve. When you listen to me today, just try to get an intuitive feel for how the indicators or ideas are working without worrying about the details. If you miss something, you can go to my website to get additional information. Please sign up for my free weekly newsletter for market analysis and trading ideas. And there's also a 30-day trial that you can play with to understand how the indicators can help you trade better. Let me take a few slides to introduce myself. I've done all the important tasks that touch on trading. I want you to believe in me to sort of mix metaphors. I've stood in a very hot trading kitchen for a very long time. And there are all sorts of speakers on the circuit, but you'll see I'm quite different from most of them. In short, I'm a trader. I live to trade, I trade to live, I think like a trader. I've done it all from system development to programming to trading to marketing and compliance for a very long time, taking real risks with real dollars, competing with the big boys with my neck on the chopping block. So I like to joke that I did not learn trading by a process of trial and error, but rather by a process of trial and terror. Let me take a few slides again. I was the first to create adaptive indicators. I've developed many original indicators that are very popular, such as Zaroon, Stochastic RSI, and CMO. I've written several books that have been translated into other languages. So I've done cutting edge research. My indicators are included in many major commercial products. So I hope this introduction convinces you that I know a little bit something about trading. Okay, enough of that. Let's change gears and get ready for some X's and O's. So today I want you to look over my shoulder and let the ideas just wash over you without worrying about the details. Just try to get an intuitive understanding of what the indicator is designed to do. And of course, if you want more details, you'll find them at my website. So what's the big picture? So human decision-making can only handle 4 or 5 independent variables simultaneously when you're under stress. So if you're a new trader or a discretionary trader, you may find that your decision process sometimes gets overloaded. So there are too many indicators, too many opinions or tools. The indicators are too many parameters to choose or set. There's just so much information and some of it is conflicting. So this can overload your decision trees and make you less decisive. At the same time, you must adapt to the markets and be flexible. So what's the answer? The answer is automation. The answer is my UltraFlex indicators, because they adapt so you don't have to. And they're plug and play, so you don't have a steep learning curve. So that completes my introduction. And what do you see here? A bowl of Rainier cherries with a red Bing cherry on top. I've tried to consciously avoid cherry picking the best examples, but a little bias is hard to avoid. So just a little caution. So be a little cautious about my specific examples and try instead to recognize the patterns that I'm referring to or showing you and how they repeat. Okay, let's look at some charts. So what do you see in this chart? This is a NASDAQ futures contract from March, a 10-minute chart. And without knowing anything, what do you see? There's some kind of price channel. And when the bars are inside the channel, they're yellow. When the price breaks out, the bars turn green or red. The breakout is clear with low ambiguity. So there's no doubt that the bars are outside the channel. In practice, you should have no trouble figuring out how to trade this chart. Go long when the bars are green or go short when the bars are red. So that's a trend following strategy. The opposite would be a counter trend strategy where you would buy at the bottom of the channel and sell near the top of the channel, or vice versa. The channel is my adaptive Chande adaptive price channel, or CHAP. The bands are wide when the market is consolidating and narrow when the market is trending. Also, when prices are trending, the channel is delayed, i.e. it is offset from prices. So first, this behavior is different from the standard price channel. And second, it makes it easier to see the breakout. So that's sort of the general design process. We want to make the breakout easier to see. So that's step one. Let's add another level of information. So this is the price chart, daily chart for SVXY, the ProShares Short VIX Futures ETF. SVXY is unique because it rises when volatility decreases. And we have two panels. The upper panel has a chart on the CHAP, and the lower panel has a filter. I call this the Colt 1 filter. It's a long-term filter on a scale from plus 100 to minus 100. So now we can combine the entry signal process, i.e. the channel, with a filter process to either confirm the breakout or not confirm the breakout. So if you just follow the circles from left to right, on the first circle, the SVXY was trending, and then the Colt was at 100. So yes, we got a trend. Then the market reversed. In the second circle, it was at the bottom of the channel. So it was a counter trend buying opportunity because the oscillator didn't go all the way down, say below 80. Then the market rebounded. We got a little breakout, not much of a follow through. Then again, a counter trend entry point, then a breakout again, this time again a confirmation from the oscillator, and we got a bit of a trend that we could have traded. Then it went sideways, a bunch of yellow bars, then a sell-off. Now this is kind of close because the market broke down pretty convincingly, but the oscillator kind of didn't go all the way down. So it was a bit touchy, but it was a bear trap, as they say, because it reversed into neutral territory again. Then we got a breakout, but everything was yellow, even though we had confirmation from the oscillator. And then finally a breakout with green bars, nice follow through, and confirmation all the way from the oscillator. So now we've added an extra layer. We had the breakout entry process. Now we've added a filtering process, and we can use this to either confirm or not confirm the breakout, or the counter trend process of entry if you want to use it that way. So now we need one more activity here, and that would be to say, how do we add exits to this process? So let's add some exits and see what happens. So here I've removed the lower panel with the filter, and I've just used the SVXY breakout with the CHAP channel, but I've added an exit strategy, the red dots. So the red dots are starting from the 20-bar channel, and they're, when you first get a breakout, you see they're pretty far away from prices. So essentially what you have is you have a large gap between the entry and the stop, or where the stop is starting, and then the stop is accelerating as the prices advance. So same thing here. We had the initial breakout. We were far away from prices, so the stop is very loose. Another breakout here, stop is tighter, but again, it accelerates very rapidly towards prices. So the advantage of this approach is that, first of all, there's no ambiguity about where to place a stop. And number two, you don't have to pick a top because you can just run along and let the exit be your guide. So now we've put the three pieces together. We have, in the two slides, I showed you the breakout, then I showed you the filter, and I showed you the exit. So if you put the three together, all that's left is money management. So, and you can add that to this process based on your risk preferences, and then you'd have a trading system. But we're stopping one step short of that. Let's continue to explore this pattern and look at Home Depot prices. Now, the reason I put Home Depot here is that, first of all, it's a stock, so it has a very different volatility profile, looks very different from a futures contract or something based on a futures contract. Second, what you see is a large swath of yellow bars. So when you have all these many yellow bars, you can step out and just ignore and not have to worry about doing anything. Now you see here we had a trend confirmed by the filter. We got a little attempt at a breakout, but no confirmation here. Again, we got a little breakout attempt here, no confirmation. Then we got a breakout here with confirmation, but it was a bear trap because it reversed. So you need some kind of exit to get out. And then we had this very nice, strong breakout that was confirmed with the oscillator. Now, the thing to note is that when there was a breakout, i.e. the prices were outside the band, there was no doubt that they were outside the band. So it's very easy to interpret this chart, and it shouldn't be difficult to decide what you want to do with it. Let's look at the exits in a little bit more detail so you can see how the pieces fit together. So here I've zoomed in on the HD chart to look at the last two trades that we talked about. The thing to note is that I've used the 20-bar channel, the dashed blue line, as the starting point for the exit. So the short exit starts on the 20-bar line and accelerates towards the prices. So if you entered, say, somewhere here or here, you had a very definite exit point from an accelerating exit. And say you got out on the exit or the next day or the day after, you still were doing all right. Then you got a breakout here that was confirmed. Again, see how the stop is very far away from prices. And then it accelerates pretty rapidly. So this is an example of an accelerating exit. And we're just using it with some default settings, nothing magical. And we're using it from an arbitrary starting point, a 20-day channel, which again is nothing magical. So the idea is that you can have tremendous flexibility in how you set up your trading process. And the three pieces again are entry signal or breakout signal, then a filter process and an exit process. Okay. Let's change gears again and look at a different instrument. This is a cross rate, the dollar-yen cross rate, which has again a completely different volatility profile. And I wanted to show this because now we've looked at three completely different types of volatility. Why is that important? Because these indicators are adapting automatically, so you don't have to, which means that they have to be able to deal with a wide range of volatility conditions. And this is an example of a cross rate, which has a very different volatility signature than the previous two items that I showed you. So here we have a bunch of yellow bars, maybe a potential breakout to the downside. So let's keep going. What do you see here? What you see is we have a breakout. We have green bars. We have confirmation from the oscillator. We have confirmation from the oscillator. We have breakout and green bars. So at this point, the trading strategy is pretty clear. You want to be long, and the entry is up to you in terms of whatever your comfort level is. So what do you think happened? Let's keep going with this chart. And lo and behold, we had a great trend. The market went higher with a few pullbacks along the way. So thing to note is this is where we got our breakout, confirmed by the oscillator, continued breakouts as it went higher, and we had continued confirmation from our oscillator down below. So again, the two main pieces, an entry process, i.e. the channel, and then a filter process, i.e. the oscillator, and now you have the exit. So let's talk about exits and their philosophy and how do you design exits. So we'll get a little in-depth understanding, and we'll try to discuss exit strategies schematically, sort of, what should be our approach for designing an exit strategy. So setting stops for an exit strategy is an art. And for new traders, The problem is they don't have enough experience to know where to start and how to proceed. So the first problem or challenge is that no one knows the duration and amplitude of the move when it first breaks out. So I showed you an example where it was a bear trap, it broke down below like HD and reversed, or you saw with the US dollar yen cross rate, it broke out, came back, and then continued going higher. So we don't know how far it's going to go. So that's one problem. Then the other problem is that it's hard to decide how quickly to move the exit, like how you should move it and how rapidly it should accelerate. At the same time, you need a specific exit, and ideally you have a unique exit so you can set stops that cannot be easily manipulated by other people. So in other words, you need control over the starting point. You want to be sure you know where you want to start your stop, and then you want to control the acceleration, like how quickly it moves in response to what the market is doing. But there's one additional design philosophy that you need to be aware of, particularly from a trend following point of view. So the basic chase philosophy is TOPS COLA. So TOPS stand for take our profits slowly. That is, we want to preserve profits. And then the COLA stands for cut off losses at once. So we want to conserve capital. So in theory, we want our exits to conserve capital effectively and protect profits efficiently. At the same time, we don't really know what the market is going to do. So there's this back and forth between the unknown and yet the needs of preserving capital and capturing profits. Okay, so let's go back to the dollar yen cross rate and look at the chase one exit, which is the chase stands for Chande accelerating stop exit with some default setting that I've called 1. The interesting to note here is that, again, we're using the 20 bar channel. This is just our reference. The prices are starting from the 20 bar channel. Just as a reminder, the breakout came in this general area. So in terms of the trade, this worked beautifully, right? Because there's no ambiguity as to where you had to place your stop. You didn't have to do anything great. You just pick the default value of 1 and you pick a starting point of 20 bars, which are all pretty arbitrary. And it got you practically all of the trend. So if you could do this all the time, you'd be a very happy trader. But then you say, well, that's all fine, but what happens if I had chosen a different speed? So let's try a faster speed. So this is the same dollar yen chart with the same 20 bar channel. And this time you'll see that we've gone to a chase speed of 2, which is a faster speed. So what should we expect if it's a faster speed, right? It moves faster, so it's going to bump into prices sooner, so we should get out earlier. So again, as a reminder, the breakout generally occurred in this area, pulled back, rallied to a new point, and we would have been stopped out. At this point, you have no way of knowing what the market was going to do next. So you step out. Then if it's your responsibility to get back in because it took out this old high, and you see that our indicator or our accelerating exit is back to the 20 bar channel, keeps pushing ahead and gives us a really good exit because we don't know what's going to come later. But again, automatically just using chase equal to 2, a faster exit because it got us out once here and then we had to get back in and then it took us all the way till here. Then you say, well, okay, that's great, but maybe I had used a faster exit. We don't know. So let's try a different exit, which is even faster. So in this case, this is chase equal to 3. And you see that just as a reminder, our entry came in roughly at this point. The 20 bar channel is our starting point or our reference. So this one, the first time it was so fast, it got us out almost right away after the first pullback. So then you have to get in here or wherever you felt like. Now this one avoided this pullback, took us all the way here, and we got out here. So you remember the other exits went somewhere over here. So this one went even faster and took us out earlier. So right away, it reverted back to the 20 bar channel. And say you got back in here, then it would have caught up with prices and gotten you out over there. So roughly an even trade. So again, we didn't know what the market was going to do. We had a preference for a fast speed. So we chose a fast speed and we just follow along. It was exact, it was precise. It told us, we specified a starting point and it could accelerate really rapidly and catch up with prices. And by design, you see it was very far away from the entry point. Like initially you want the exit to be loose and then you want it to be tight. And you see it tighten very rapidly. Now, you can still say that, well, this is all very fine, but if you're a long-term trader, you might say that, oh, that's all great. You've shown us all these exit speeds, but these are too fast for me. The chase exit allows you to build custom speeds. So here we've chosen a much slower exit strategy. Now, again, as a reminder, our entry was somewhere over here. This is the 20-bar channel that we're using as reference. So you see this exit started the 20-bar channel and then started marching higher. And you see that the longer it went, the faster it was accelerating. Now, we don't know what the prices did here, but you can imagine that eventually it's going to catch up and get you out somewhere over here. So this is an example of saying that, I'm a trader with a certain style. I have a certain, speed of reaction that I like. And so I can design an exit strategy that meets a variety of needs. So just to sort of look at the overall view of what happened, this was the fastest, then the next fastest, then the next fastest, and the slowest. So this was chase 1, chase 2, chase 3, and chase custom. The red arrow shows you roughly the entry point. So you can see that the same algorithm with 3 default values and 1 custom value could give you completely different P&L, different entry points, different exit points, and allows you to trade in a way that makes sense to you and gives you tremendous control over the outcome. At the same time, you don't have to know anything, in the sense that it is giving you a specific exit point. You don't have to pick a top. You don't have to worry about the exit being too slow, because it can move really quickly and catch up with prices. So this slide essentially illustrates the power and flexibility of the chase exits. So naturally, when the breakout starts, we don't know how long it will last or how far it will go. So we have to commit to an exit strategy. So for example, you could start at 1 speed, but change it if your intuition tells you the trade will go on for a longer time. So for example, if you see this pattern, if you see this pattern where it broke higher, came down, broke higher, came down, broke higher, you'd say, whoa, I think this is going to go much further along. So if you're on this strategy, for example, here, you could say, I'm going to go to a slower strategy or a slower strategy. So you have a way of adapting or changing how you want to trade the market. Or as I said, you could break your position into smaller bits and trade each piece with a different exit. Okay, let's take a little break. This is sort of one of the reasons why I like to trade, being able to sort of sun on a beach and on the big island in Hawaii without a care in the world. So, it's a useful goal to have, to know why you're trading. All right, let's change gears a little bit now. So I want to take you a little bit deeper into the details of how we created the entry process, i.e. the chuff band and the chap bands, and show you that they behave very differently, and in some cases exactly the opposite of what their conventional counterparts are. So in this case, I'll spend some time with the chuff design, because that sort of gives you a feeling for what we are trying to do. So chuff stands for Chande Ultraflex Moving Average and Bands, and it's ultra flexible because it automatically adapts the look back period, the multiplier of the bands, and the offset or delay. So essentially, all the things you can tweak for moving averages and bands, it does for you automatically, without worrying about what's happening and without worrying about the volatility of the market. So the way I'm going to do this is I'm going to use the LRCX, which is Lam Research. This is the COVID-19 sell-off, a big drop in 2020. The standard is a 30-day SMA, and the Ultraflex is designed to go from 5 days to 30 days. It's a simple moving average, but the length varies. So in this case, the 30-bar channel is the 30-day SMA is the brown line, and the blue line is the 5-day adaptive moving average. So you can see that the 30-day average is moving along pretty slowly, doesn't really change much when the prices drop rapidly. On the other hand, the adaptive moving average drops very rapidly and hugs prices when the volatility is high, and then it slows down and meets and has about the same value as the 30-bar average again in this area when the volatility drops. So this is an adaptive average that has automatically adapted to the increasing volatility by decreasing its length. And you can see that when the volatility eased up, it went back to being a 30-day moving average. So we're going to use this adaptive behavior to construct bands that give us a trading advantage. And why is that relevant? So let's look at the 2 sigma 30-day Bollinger Bands. So the first thing to observe is that when you're outside the bands, the prices tend to reverse towards the center or towards the moving average. So they're really set up for counter trend trading. The other thing to observe is that see how wide the bands get when the volatility expands. So when the volatility expands, the bands expand. When the volatility contracts, the bands contract. And what we're looking for is something different. So the chuff bands do the opposite. So what do? The opposite behavior means that the chuff bands are narrow when the trend is strong, whereas the Bollinger Bands widen, and they are wide when the trend is weak, whereas the Bollinger Bands are narrow. So the opposite behavior. And you can see that in this chart by looking at the red and blue lines. These are the chuff bands here, and the brown line is a Bollinger Band. So you see the Bollinger Band is very wide here, whereas the chuff bands are very narrow. They're following the prices, and they're offset from the prices. So you can see the breakout very clearly. Whereas if you look along the dotted line here, it's not that clear exactly that there's a breakout. Then the prices came up and relaxed. So you see that here, the Bollinger Band has narrowed compared to where it was at the peak, whereas the chuff band has widened compared to where it was when the volatility was high. And then here we have sort of a trend, a choppy uptrend, and you can see that the chuff center line is offset from the 30-day moving average because it has detected a trend. So the behavior of the Bollinger Band and the chuff bands are completely different. When the volatility is high, the chuff bands are narrow. And when the volatility is low, the chuff bands are wide, which is the opposite from the Bollinger Bands. And that's what gives them an advantage in terms of being able to trade with them. And we can do roughly the same thing with the price channel. So I'll show you that as an example. So again, the standard price channel is named after a gentleman by the name of Donchian who thought about it, I think in the 50s or something. Again, we want it to be narrow when the trend is strong, whereas the bands widen or the channel widens, and we want to be wide when the trend is weak, whereas the channel becomes narrow. So again, the opposite behavior. So we can take advantage from a trading perspective. So again, we have the Lam Research chart, and this is the COVID sell-off. The dotted line here is the 30-day Donchian bands. You can see they're very, very wide. So you see they're very wide when the trend was underway, and then they narrowed as a trend. They narrowed a little bit when the volatility relaxed. But you see the CHAP channel was relatively narrow, or much narrower when the trend was underway, and it was massively offset from prices. So it is very easy to see the breakout when it was occurring, whereas it's much harder to see that with the traditional Donchian channel. Also, you can see that as the volatility relaxed over here, the price channel is wider. So compared to say when it was here or here. So again, schematically, we're getting completely opposite behavior from the CHAP channel versus the Donchian channel. And the main thing it does is it allows us to see the breakout very clearly. So if you remember the first chart I showed you about the 10-minute NASDAQ chart futures, when the prices were outside, they were outside. It was very easy to see. There's no doubt about what you're seeing. So this is sort of an example of where the design process itself can give you a competitive advantage. And all we're trying to do is make it very, very obvious that the breakout has occurred. So let's take a short break here. I find this picture very thought-provoking from a trader's point of view. I can't decide if he's bored or he's getting ready to bite somebody's head off, because sometimes trading feels like sticking your head in the mouth of a hungry giant or a hungry lion. So just a little food for thought. Okay, so let's go back and sort of look at what we were trying to do, right? Like, why does Ultraflex help you make any difference? So in quote problem between the bands and the Ultraflex solution. So clearly breakouts can be ambiguous, right? We saw that because the prices can walk along the edge of the Bollinger Bands, or they can walk along the edge of an ever expanding channel. And it's not clear that the breakout is occurring. Whereas clearly, because we make the breakouts more obvious, because we shift away from the price, and also because they narrow rather than widening. So the breakout is easier to see. Then certainly another problem is that the breakout can stall. We saw a couple of examples of that in HD when it reversed in a bear trap. We saw in HD, or we'll see in Amazon, that we tried a couple of breakouts, but it didn't quite work. So the breakout stalls. So we need the filters to confirm that. So we have the short-term and long-term filters. And I showed you, when you remember, when we had the breakout in HD, for example, or in the Japanese yen, the oscillators were near 100. So we have some additional confirmation that the breakout is probably going to continue. And then we've already touched on this, that the width expands during major trends. So whereas we've taken the opposite design tack, the width narrows during major trends. And of course, the internal time periods are fixed, and all the internal periods adapt automatically based on whatever the algorithm is. So if you just look at it from a design point of view, we've really tried to find a solution that's completely different and solves the major stumbling blocks with the traditional breakout tools. And remember, these tools can be used on any time frame. So you can use them intraday, you can use them daily, you can use them weekly, you can use them monthly if you wanted, if you're an institutional type. And then the exit strategies themselves can work on any time frame. So what may look fast on a daily chart will look slow on a weekly chart, and so on. So you have another big lever you can use to make or to change the effectiveness of these algorithms by changing the time period. You can go from a shorter period to a longer period, and the same thing will look like it's moving more slowly. Or of course, if you go to a shorter time period, a slow choice may look faster. But that's another design parameter you have to help you trade better. Okay, sort of a top level look at what we're trying to do. We have entries, we have filters, we have exits. Then there's a money management layer on top of all this that we've not explicitly talked about. Clearly, we're talking about adaptive breakouts. We have two different types of oscillators, short-term and long-term, because again, this gives you more opportunities to confirm the trade. And then I've showed you many examples of flexible trailing stops. Same slide, but now we put the names in there. We have the CHAP and CHUF. Then the cost, which is the Chande oscillator short-term or the Chande oscillator long-term, to give you additional filtering options. There are 4 different types of filters, and then the Chase L or Chase X for long and short trades. Now, it's very important that we have separated the long trade exit from the short trade exit. As a trader, I find it extremely helpful to be able to have different speeds and feeds of exit for long trades versus short trades, because a lot of them, the short trades move very rapidly. For example, the sell-off for the last couple of days. So being able to separate your long and short exit strategies is also a tremendous advantage from a trading perspective. So let's go back to where we were in the beginning. Where do we need help? We got too many indicators, too many opinions, lots of charting tools, tons of parameter choices, information overload. The decision tree needs some pruning, or is getting overwhelming. So we can recover from that with automatically adapting to the markets. just a reminder again, ultra flexible means we adapt automatically. We adapt so you don't have to, and you can start using them right away. All right, let's sort of start summarizing a little bit. We want to embrace the power of simplicity. So if I want to show you all the formulas, I'd say, oh, this is so complex, but that's the whole idea, right? The complexity is hidden underneath the hood, and what you have is something that's simple, clear, and powerful, and very, very flexible. Oops. I'm going to run through a bunch of charts just to remind us and sort of wrap up and give you a sense of what's happening. This is Amazon here with the breakout confirmation, lots of yellow bars, then a sell-off here with confirmation, and then a breakout with confirmation. So again, a large cap stock, very easy to trade, lots of yellow bars. You see the pattern keeps repeating, looks very similar from before. This is waste management, a stock, but this time I've shown you the cost 1 and cost 2, the short-term oscillators. So what you see here is, again, lots of yellow bars, a breakout with confirmation, a nice trailing exit, and multiple confirmations. So the 3 building blocks are, we have a breakout process or a channel, and then we have confirmation, different filters of a lot different length, and then we have a trailing exit. So all you have to do is add money management. But the same process repeats. That's what you're looking for, even though the underlying volatility can be very, very different. Sorry, I don't know why it's all jumping around. Now I've shortened the time frame to 3 minutes. Now this is again an example of using Chuff with the E-mini S&P. We have short-term oscillators. So we've gone from a daily chart to a 10-minute chart to a 3-minute chart, and the chart and the process looks essentially the same. And that's what we're looking for. We just want consistency in terms of how we want to react to the markets. Now, you can say, well, this is all great, you cherry pick the examples, so what? So what I did was I put charts from yesterday and today. Essentially, I made these slides a month ago. There's absolutely no way for me to know what the markets were going to do. So this is what it looked like yesterday. This is the chase exit. We had this very nice sell-off. You could have just gone, again, this is a 10-minute chart, starting from the 20 bar channel like we've always done. We have nice confirmation here with our cold 1 oscillator, and there's no doubt that you want to be short coming in here. And then of course we had the sell-off towards the end of the day. Again, you could have followed with the exits and gotten out over there. So and what it looked like to this morning, clearly I had no idea what would happen today, a month ago. Same thing, 10-minute chart this time. This got this beautiful exit, and you'd have gotten out midday somewhere over there. So again, the point is that, and just to touch base again, see, we had this very nice confirmation from the cold exit, and it's close to 100 for the whole duration of this move. So a move like today is a good example because there's a lot of emotion yesterday, a lot of feeling that, oh boy, the trap door is going to open and the market is going to fall through. It rebounds today, rebounds strongly. And then when it's rebounding and moving rapidly, the whole question is, where do you want to get out? And do you want to get out too soon, too late? Don't have to worry about it. Just let the default chase 1 exit do the work for you. So again, the point of the slide is that it may seem that we had optimized, but really it worked just as well today in exactly the same way. All right. So to summarize, these are very powerful indicators. They're adaptive. They're simple. They're only for NinjaTrader. So give yourself an edge. Start the trial, play out with it, see what happens. And then there are plenty of resources. I have a free newsletter at chandeindicators.substack.com. So you can use that for market timing and trend analysis. On the website, we have a bunch of other tools for robot portfolio construction and for scanning stocks and ETFs based on the same cold 1, cold 2, etc. indicators. So you can apply those indicators, for a much larger sample to find trading opportunities. So I hope that you'll use the code. Remember, I need the machine ID, which looks like that, a gigantic string, and you can find it under help, about, and machine ID. So that's it for me. I hope you've gotten some information out of it. I want you to take it away, and I'm more than happy to answer any questions.
Tushar, if you want to go ahead and spend about 5 minutes answering some questions, I can close out the room once. Let me know.
Yes, let's do that. That's good. So one of the questions here was that, how do they perform in highly volatile markets? And I would say that they perform just fine, right? I've showed you a 10-minute chart. I've shown you a 3-minute chart. So when you talk of volatile markets, what you're really talking about is what is the underlying time frame. And for example, something that looks very volatile on a weekly chart may not look that volatile on an intraday chart, and so on. So they do fine on volatile markets, but obviously one of the things in volatility in a volatile market is that the entry filters can get tricked, and also in terms of exits, sometimes the exits will move too rapidly, right? And then can you use them on tick-based bars? The answer is yes. The main problem with tick-based bars is sometimes the ticks get corrected, so you always have to worry about getting a false signal. They're in NinjaTrader, so anything NinjaTrader can compute, should work just fine. And then there's a question here: are they compatible with Bloodhound and Blackbird? I don't know that. I don't know what you're referring to. For example, would they work, on non-time charts? I'm not positive. I've never really used them strictly in terms of range, so I really can't answer that question. I have done my own simulations, but I encourage you to really do your own, because they're in the system. You just have to set it up and do it. The usual answer to these things is that discussion of results, I have to give you all sorts of disclaimers, so it's almost pointless. So you should really do your own testing, but they should work pretty well, because after all, they're adaptive, and the other ones are not. So there's an advantage for them right away. And then did you show futures? I hope you got a chance to see that. Yes, you can definitely do futures. I did those at the end. Typically, index futures should work just fine. If you want to do it on things like soybeans and corn, they should work just fine. The only thing to think about is things like energy markets, because then the thing with the energy markets is, because you have a monthly roll, the volatility keeps changing. So in effect, as soon as you do a roll, there's not only a shifted prices, you shifted the volatility. So the stops will be affected, because because the volatility has shifted. That's something to worry about. But overall, it should work with futures just as easily. The only thing to worry about is right around the time of the roll, because essentially you're changing the entire underlying volatility on the day of the roll, and the volatility shift could affect your stop. And the other thing to remember also is that a lot of times you have to be, the way the thing gets plotted, it's being plotted one day late. So on the charts, what you're seeing is you're seeing tomorrow's value today. So it seems like sometimes you can get close to prices and not get hit. So you got to worry about that. Let's see. Expose plots to NT8 custom. Yeah, I guess yes, you can write any code you want around them, because you just have to bury it in your own code. After the coupon, the price will be around $60, I think. Which is probably not an unreasonable price for being able to try them for a month. Let's see. Order flow, moving averages, yes, it takes care of all of that. They're all buried in there. The way you have to think about these indicators is that they're indicators of indicators. So I'm not explicitly taking account of how should I say, of volume, but I'm taking account of price. So these are price-based indicators, and I'm not accounting for things like the depth of market. So I'm not accounting for that. So in that sense, if you're a big fan of depth of market, the depth of market is not in the formula, but ultimately it'll be reflected in prices. So these are price-based indicators. So that's their strength and weakness. Let's see. This is a monthly subscription. No, there's I guess there's a one-time cost. Once you get it, it'll work forever. I think it should work on NT7. I mean, I've not tested it on NT7, but these are very generic functions, and I've written my own when necessary, when needed. So I don't expect any problem running it on. After the cost, it's $1,000 for the whole thing, and so it'll be $925 or whatever after the trial. And there are 8 indicators in all. And the way I look at it is if you can get one good exit or one great entry, it'll more than pay for the trade, more than pay for the cost of the trade, really. And ultimately what happens is that sometimes there's so many things happening in the market, it's really hard to get a grip on it. And what you want is you want the same repetitive process that gives you the same visual impression and signals so that you can be much more consistent, and it's a lot easier to deal with the ups and downs of the market. So that's really what I'm going for. And you can see that the behavior is completely different. It is not remotely connected to what the usual indicators are doing. And then yes, you can use it on the NT platform, but you still have to buy the package, and you have to send me your the big machine ID for me to activate it for you, etc., etc. Let's see, more messages. Yes, you'll have to buy the whole package. I have not broken the indicators down because that's a can of worms, but you have to buy the whole package. And the way I look at it is that even though you may like one particular package more than something else, you might change your mind. You can find something else more useful 6 months from now. So it sort of ebbs and flows. Let's see more questions. I think those seem to be most of the major questions. I think we have one more. Let's see. Can it work on the Meta 5 platform? It should. Do I help with installation? Yes, it should not be a problem. If you look, so the way this is done is that it's you get like a zip file, and then you just go in there and you say import, and this is all being tested, so it should work pretty seamlessly. You don't really have to do very much with the installation. You just have to you have to activate it, and then you go into NinjaTrader and say, hey, get me this package, and it just does it for you and puts it in its own subdirectory, so it'll be very easy to find. So installation is pretty straightforward in terms of so I'm happy to help, but it's pretty much it should take care of itself. Shouldn't be a big problem. Let's see. I think those were the bulk of the questions as far as I can tell, unless I've missed somebody's questions. No, I think that was it, Bonita. I think we've covered most of the questions. Do you have a training platform? Training for platform. Do you have tutorials? Yes. So when you I also so when you buy the package, I also send you like a 20-page PDF with a very detailed explanation and examples. So you'll have a lot more insight than what I've done here. So that is written sort of in a tutorial style. It's very basic, and I've gone through step by step. But you have to remember is that my write-up only focuses on the indicator itself. Again, from a regulatory point of view, I don't go into you can trade this way or that way, because that gets all messy in terms of regulations. But it should be pretty straightforward. What else? That's it, I think. Any other questions? Or I encourage you to try after sales. Well, in general, it's a one and done deal for me. I'm happy to answer a few questions. I'm happy to give you some support, but it's not going to be infinite, obviously, because I'm juggling my own trading on the side, et cetera, et cetera. Yes, I will definitely give you some support after you buy it, and I'm happy to help you. But I can't tell you that trade this, right? Do you understand? I can't give you specific trading advice, but I'm happy to sort of answer any questions. Do you have a trade room? No, I don't have a trade room. My days are so busy. Yeah, it just costs. It doesn't cost $1,000K. It just costs $1,000. If it costs $1,000K, man, life would be good. How do we navigate the website for trials? You just have to register, and then when you register, it gives you an option to buy it. When you hit buy, you'll get a mail. You have to send me. You have to send me a machine ID, and I'll send you a download link with the PDF, and you just have to download the link and install, and then you'll be good to go. Let's see. Well, I hope you've enjoyed the talk. I'd love to do it again. I'm sorry for the glitches that came on. I'm sure I'm going to hear a lot about from my kids. They're not going to let me off easy on this one. But hey, we survived. We got to the end without too many crashes and burns, I guess. Anyway, any more questions? Oh, thank you very much. And also on the website, since we're talking about it, I have a bunch of new tools that I've just put on there. There's a portfolio construction tool that you can use to decide, how do you build a retirement portfolio. And then these indicators are also available as tables. So you can, there's a table for stocks and there's a table for ETFs, which uses some other indicators and the cost one, cost two, colt one, colt three, and their sums. So it's a very nice way for you to take what you learned here and extend its reach by using them to search for trading opportunities using stocks and ETFs. Now, that may be a little slow for some of you guys because they don't quite move with the same intensity. But it's an opportunity. The way I look at it is that even though you may not trade it, by looking at it, it can give you a sense for intermarket confirmation, right? Like if the corn ETF is trending, CORN, then you know that the corn market is going to be is trending as well. So it just gives you a chance to confirm what it should look like. Or if other commodities are trending, then you know that. So the ETFs are a good source for other intermarket relationships. Do you have YouTube videos? No, the trial is for 30 days. And if for some reason you can't do it in 30 days, I'll give you a little extension. So 30 days is sort of a floating number, but it's set up for 30 days. But if you need a few days more, we can work it out. Lifetime support with updates. Well, the quote lifetime support is not lifetime. I'll give you some support, but it can't go on forever. What about new indicators in the future? Well, I'm doing lots of research. I'm constantly doing research. It's one of the curses of being a trader that you also have to always doing research. So, so it's possible, but I don't have anything specific. Okay. So on the website, you have something called Stock Finder and ETF Finder. So there are tables. So if you click on stock, you'll find that a table with all these indicators computed for only stocks. And on the ETF side, there's only ETFs. And there are 5 things. There's RPM, which is a relative performance meter, which looks at year-long performance on multiple time periods. And there's a cost 1, cost 2, just like we have here. We have colt 1, it seems like here. We have colt 3, which is slightly different than colt 2. So you have the same variables pretty much available there with the addition of RPM. And then you can essentially rank or sort by each column, right? I guess in order to do yes, you have to register in order to get the NinjaTrader part of it. But to use the tables are outside in the public domain, everyone can use it. But to get the actual link and pay for it, you'll have to register because, again, various regulatory reasons, it's better to do that way. Free trial cost, no, the free trial costs $60, not $800, but the final cost is around $1,000 minus the cost of the trial. So the trial itself is only $60, which is like nothing, a few cups of coffee. All right, I think we've answered a lot of questions.
Thank you so much.
Thank you so much, Manita. I had fun. Let's hope we can do it again.
Of course. And I just want to give you a special thank you, Tushar, for this great presentation. And everyone here in attendance will receive an on-demand recording of today's event. Please keep an eye out for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. So if you find value in them, we hope you will attend them on a regular basis. We'd like to remind you the information provided in this was that of Tushar of Chande Indicators LLC and not of NinjaTraders. All information is for educational purposes and should not be construed as trading advice. Again, we do appreciate the time you spend with us, and we hope that you enjoy the rest of your day, and happy trading from everyone here at the NinjaTrader Ecosystem. Thank you.